Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Dr. Joseph Lai, Chief Investment Officer at OxCap Management. He's going to be talking to us about the major themes shaping the future of investment in emerging markets. Hello, Joe. Welcome.
Glad to be here, Anna.
Great. 2025 has been a very eventful year so far, to say the least. What's changed in the investment landscape of emerging markets? If you can paint a picture for us.
Sure. The most significant change is that some of these emerging markets actually starting to outperform that of developed markets, which hasn't been the case for a long time. And I think what's happening and changing is just simply that there's a greater awareness that the macro resilience of some of these economies and companies within these economies are actually more robust than people thought. Be it the amount of national debt is much lower than developed markets. The institutions within these countries are improving as they want to catch up, to the wealth level of developed countries. And the second thing which is helping these markets so far has been the weakening of the US dollar. The US dollar has been a bit of a headwind, a problem for emerging market valuations. And interestingly, with the rise of what's happening in the world, what's happening in the US, there's a great expectation. In fact, the US dollar has been weakening against most people's expectations actually early in the year. So that's helping emerging markets. A weakening US dollar is good for emerging markets. So, it's quite interesting. I mean, we just focus on quality franchises within these areas in emerging markets. I mean, that's been quite fruitful.
Off the back of everything that's happening in the US. So how is US policy and current geopolitical tensions, reshaping investment opportunities across the broader emerging market landscape? And how is it changing the way you invest?
The Liberation Day in April this year, the numbers that were proposed by the US government was bigger than most people expected, right? And then, so these reciprocal tariffs was very scary to the markets and caused a big sell-off. But as you can see, I mean, a lot of the markets actually regained all the losses, if not more, than before that particular day. And I think the statement to be said about that is that, in a world of multipolarity in which no particular country holds all the cards, it's very hard to actually force other countries to do what you want. Yeah. We've experienced it in Australia when we got some issue with China in terms of barley or wine or whatever. We just find someone else to sell the goods into. So be it tariffs, I mean, there's more than one country you can sell the products to. Be it technology restrictions, there's ways around various things. So I think the outcome is actually, tariffs not good. From an economic perspective, it does impact some companies specifically, but ultimately, these economies are dynamic and the markets are dynamic. Entrepreneurs and capitalists, find a way around these issues. And I think that's what we're seeing, is that a lot of noise, but actually the impact so far has been less than initially thought anyway. So I guess what we do is that we think the world is volatile. I mean, I think given the changes in the world, we want to focus on quality franchises companies. So these are companies which can grow robustly in a resilient way, even in a more difficult global environment. So it doesn't really change what we do, but we're ever more focused on companies with those, characteristics, strong economic moat, strong management, good balance sheets. So that's what we do anyway.
Okay. So can you tell me what the biggest misconception is for investors about emerging markets and investing in them?
I would say most investors, when they think about emerging markets, the first picture that comes to mind are commodity producers, low tech, generally, I guess, less wealthy people. But I think a lot of it is actually, maybe it's true 20 years ago. Today, when we look at a lot of these emerging countries, they are not, commodity production is not a big part of the economy anymore. And in fact, a lot of them don't even export that much anymore. They've got a large domestic economy, and the institutions are actually have been improving over the years as well. So this idea of a really backward, commodity-heavy, really dirty countries, I think that's at least to some degree, is not true. And when we look at the actually exciting stories or exciting stocks in a lot of these emerging countries, they are of the industries that are not that different to that of the developed economies. Be it in internet, companies. There's lots of AI investments, particularly in countries like China. The stories that we find exciting in developed markets, I think we can find very similar exposures. And in fact, those in emerging countries, and they're actually a big part of these emerging economies. And I guess that would be what I say about the misconceptions.
Yeah. Okay. More similarities than differences.
I think so.
Yeah. So, which countries or regions are showing the most promise, you feel, in the next few years?
We like countries with the characteristics of endogenous growth. They can grow by themselves without really relying a lot on exports. Improving infrastructure, improving institutions, and attractive valuation. So these are the countries include that we like include China, Indonesia, Vietnam, and to some degree India. Valuation is just a tad high there, but great long-term stories.
Okay. Yeah. And so AI and the rise of the middle class are obviously two big topics around the emerging markets, huge drivers of change. What sectors are showing the most innovation and disruption?
Yeah, artificial intelligence is an amazing revolution that I do believe in that will change the world. In the next 5 to 10 years, probably quicker than most people are thinking at the moment. The advances that's made there. We particularly like the AI that's getting implemented in Asia, and more specifically in China. And the reason why we say that is, a lot of the focus globally has been AI that's done by the big hyperscalers, big US companies, and absolutely they're fantastic. Don't get me wrong. But what we've seen with the rise of these open source AI models, like the likes of DeepSeek, and that being one of quite a few open source models in China, the thing that those things are doing is that they're really dramatically lowering the cost of AI in some of these Asian countries. Per token, the cost of DeepSeek and some of these cheaper Chinese models is literally a few percent of that of ChatGPT. And so what it does is that it is very, very cheap for all these businesses in Asia to actually implement AI into their businesses. That's still going to take time, but it's a lot cheaper. It's like having access to a cheaper source of electricity. So the diffusion of AI, we believe, will be very rapid in this part of in Asia particularly. And so we're very excited. And be it, it can be applied, as you know, AI in white-collar work, in the internet space, in e-commerce, in robotics in the future. So it's rather exciting. We're on the ramp up of those changes, which we believe will lift productivity across the region, if not eventually the world.
Okay. And how about the rise of the middle class? How is that affecting sectors that you're looking at?
Yeah, so consumption and the rise of income is a long-term theme that's very positive for emerging countries. The income level, if we look at GDP per person, they're very low in most of these countries. In Australia, we talk about per capita recession. It's this concept of GDP per person. So in India, it's about $2,000, a bit more than that, 2,000 something per person per year. Indonesia is a bit higher, and Vietnam is maybe closer to 4,000. And China, which has improved a lot in the last 20, 30 years, it's around $13,000 per capita. So, in the long term, it is actually much more likely that this GDP per capita would increase, just catching up in productivity, catching up in education, institutions, and technology, than to say that things have peaked in these countries. So when the income grows, consumption definitely will grow. So we are seeing the rise of various domestic brands in all of these countries. Eventually, people would want to have their own national brands. As opposed to buying luxury goods from Europe all the time and sporting brands from US or Europe. Don't get me wrong, they love them, but it's just that domestically they will have, this market is so big, it's so many people that they will have their own domestic brands. So we are seeing the rise of domestic brands, the rise of healthcare, the rise of the internet. A lot of them are domestically produced products actually that are very exciting. And the base is still very, very low. Next 5 or 10 years, I mean, it's very likely that they will grow 5-folds or 10-folds in some cases.
Are there any contrarian views about countries or regions that you hold right now, if you could tell us about it?
Yeah, look, I mean, the reality is, I mean, the last decade has and more has been about equities in the United States. And so, that market has outperformed, EM for a long time. So by definition, the valuation of most of these markets are very, very attractive. A lot of these, wonderful stocks are trading on very cheap valuations. So to us, they are contrarian. Great companies on cheap valuation, the PE to growth ratio or PEG ratio in a lot of cases less than 1 for quality business, quality management. So we do own a lot of them. We think they're contrarian just because they're cheap. And we believe that re-rating is likely with the falling US dollar and rising recognition of the improving fundamentals of these companies.
Can you walk us through OxCap's investment process, how, starting from the macro and how you go down to stock selection?
Yes, so what we do is very simple. I mean, we identify the future winners in these growing economies. By winners, we define as companies with quality franchise, strong economic moat, which will enable them to actually develop or grow their earnings along with the growth in revenues. So that's one. And the second is we have a strong valuation discipline. So simply, we do not pay up. So an example would be a company with great growth story, but on an expensive valuation, we just would walk away. Companies like quick delivery companies or delivery companies in India, very good growth dynamic, but it's very, very expensive. So we just don't even look at it. But when we can see other companies, even just within India, that, there's good, very strong private sector banks that are, taking a lot of market share from the state banks. And on a reasonable valuation, we're happy to participate. So good winners, long-term winners in the long term, and do not pay up. Yeah.
So is there a company that you're bullish on at the moment that isn't on investors' radar just yet?
Yeah, I think there's quite a lot, but I'll use one that I recently added back to. So there's a company called Kuaishou, which is a Chinese company listed in Hong Kong. It's like the TikTok of China. There's 2 TikToks. This is one of them. The first one is there's one called Douyin. This one is called Kuaishou. So what's happening there is that this is short video TikTok thing, and it's got more than 500 million users, still growing users, but they're just starting to monetize effectively. So they're selling advertising, they're running e-commerce things through the platform, so the result is the earnings growth for this business will likely to be around 20% a year for the next few years at least, if not longer. But the PE ratio is about 10 times. So it's actually very cheap, and they're getting some earnings revisions upwards, we believe, in coming days or coming weeks. So we're actually quite excited about that.
Okay.
Yeah.
So how have positions in your portfolio changed in the last 12 months? If you can talk us through maybe a couple of stocks that you backed or possibly backed away from.
We have actually been a bit, cautious on this China exposure, probably 18 months ago, just simply because it was going through a dramatic property market adjustment, and the economy was slowing down. But as the valuation came off with the election of Donald Trump, we actually increased our exposure to that to the companies in that economy, and the belief was just that there's actually not that much that actually can be done to significantly harm these countries, even with the change of the U.S. government. And so we were able to buy really world-leading businesses like BYD, like Tencent, and Xiaomi and the like, during that time when the market was selling off. So we increased our exposure to Hong Kong in particular since about December, January to February this year. We're still positive actually from this point. I mean, they're having some negotiations right now between the two governments. So we increased in China, cut back on some other markets which actually have held up better. And that's a major change. And really, the playbook's the same. Adding to the quality franchises in these markets when they sell off, so that they can be resilient. Because we believe these companies are resilient even in the more difficult economic environment.
Okay. So how do you manage risk and volatility in less liquid and volatile markets?
Yeah. So I guess the process comes to mind. The focus on quality businesses means that we are not taking a lot of the idiosyncratic risks in the business. Even in a difficult environment, the earnings should be able to prevail to a large degree. I mean, one can never be 100% sure, but at least those are more resilient businesses. And the second is to be macro aware. So we've got a quant model which allows us to observe what's going on from a macro perspective and be able to take evasive actions when needed. We don't do that often, but we sort of did it. We did it, straight after Liberation Day and also before COVID, which actually saved a lot of the downside or reduced a lot of the downside problems that the market experienced during those times. And so it's really just focusing on the good businesses. Don't take a lot of the idiosyncratic risk. Have a good valuation discipline, so do not take the price risk as much, and also be macro aware, so to be able to reduce some of the downside risks when the market sells off.
Okay, what does evasive action mean?
Okay, yeah, so that means for us is two things. One is when we are able to reduce exposure by raising cash, and the second is to basically put on some very simple hedges on markets, so that when the market falls, we actually can have some hedge to reduce the downside.
Okay.
Yeah.
So how can Australian investors access these structural emerging markets trends?
Yeah, I think the key about emerging markets is that one has to be quite selective in what chooses to own. And I would recommend, the stuff we do, so our emerging, the OxCap Emerging Market Fund, basically, we look for things which I think, would be quite a nice exposure, because, the focus on quality, the focus on the valuation discipline, and have the toolkit that's available to actually, reduce the downside risks when it happens. I think what's important also is just that the people doing it needs to have the experience and actually to be able to understand and appreciate the nuances of the fundamentals that's happening in this part of the world. It's sort of a part of the world that a lot of investors have taken their eyes off, and there isn't actually a lot of people with the long-term history in this market. So that's that's important to consider as well.
Okay, thank you so much, Joe, for sitting down with Livewire today and sharing your insights. Can't wait for our next chat.
Thanks very much, Anna.
Thank you. If you enjoyed that interview, make sure to give it a like, and don't forget to subscribe to our YouTube channel, where we release new content every week.